criticize bond issues, but to argue against the wanton creation of huge paper money monstrosities of this genre. Graham, an enthusiastic reader of Spanish literature, is paraphrasing a line from the play Life is a Dream by Pedro Calderón de la Barca, 1600 to 1681. The greatest crime of man is having been born. Chapter 18. A comparison of 8 pairs of companies. In this chapter we shall attempt a novel form of exposition. By selecting 8 pairs of companies which appear next to each other, or nearly so, on the stock exchange list, we hope to bring home in a concrete and vivid manner some of the many varieties of character, financial structure, policies, performance, and vicissitudes of corporate enterprises, and of the investment and speculative attitudes found on the financial scene in recent years. In each comparison we shall comment only on those aspects that have a special meaning and import. Pair I, real estate investment trust, stores, offices, factories, etc., and Realty Equities Corporation of New York, real estate investment, general construction. In this first comparison we depart from the alphabetical order used for the other pairs. It has a special significance for us, since it seems to encapsulate, on the one hand, all that has been reasonable, stable, and generally good in the traditional methods of handling other people's money, in contrast, in the other company, with the reckless expansion, the financial legerdemain, and the roller coaster changes so often found in present-day corporate operations. The two enterprises have similar names, and for many years they appeared side by side on the American Stock Exchange list. Their stock ticker symbols, RE and REC, could easily have been confused. But one of them is a staid New England trust, administered by 3 trustees, with operations dating back nearly a century, and with dividends paid continuously since 1889. It has kept throughout to the same type of prudent investments, limiting its expansion to a moderate rate and its debt to an easily manageable figure. The other is a typical New York-based sudden growth venture, which in 8 years blew up its assets from $6.2 million to $154 million, and its debts in the same proportion, which moved out from ordinary real estate operations to a miscellany of ventures, including 2 racetracks, 74 movie theaters, 3 literary agencies, a public relations firm, hotels, supermarkets, and a 26% interest in a large cosmetics firm, which went bankrupt in 1970. This conglomeration of business ventures was matched by a corresponding variety of corporate devices, including the following. 1. A preferred stock entitled to $7 annual dividends, but with a par value of only $1, and carried as a liability at $1 per share. 2. A stated common stock value of $2,500,000, $1 per share, more than offset by a deduction of $5,500,000 as the cost of 209,000 shares of reacquired stock. 3. 3 series of stock option warrants, giving rights to buy a total of 1,578,000 shares. 4. At least 6 different kinds of debt obligations, in the form of mortgages, debentures, publicly held notes, notes payable to banks, notes, loans, and contracts payable, and loans payable to the Small Business Administration, adding up to over $100 million in March 1969. In addition, it had the usual taxes and accounts payable. Let us present first a few figures of the 2 enterprises as they appeared in 1960, Table 18-1A. Here we find the trust shares selling in the market for 9 times the aggregate value of equities stock. The trust enterprise had a smaller relative debt and a better ratio of net to gross, but the price of the common was higher in relation to per share earnings. In Table 18-1B we present the situation about 8 years later. The trust had kept the noiseless tenor of its way, increasing both its revenues and its per share earnings by about 3/4. But realty equities had been metamorphosed into something monstrous and vulnerable. How did Wall Street react to these diverse developments? By paying as little attention as possible to the trust and a lot to realty equities. In 1968 the latter shot up from 10 to 373 fourths and the listed warrants from 6 to 361 halves, on combined sales of 2,420,000 shares. While this was happening, the trust shares advanced sedately from 20 to 301 fourths on modest volume. The March 1969 balance sheet of equities was to show an asset value of only $3.41 per share, less than a tenth of its high price that year. The book value of the trust shares was $20.85. The next year it became clear that all was not well in the equities picture, and the price fell to 91 halves. When the report for March 1970 appeared, the shareholders must have felt shell-shocked as they read that the enterprise had sustained a net loss of $13,200,000, or $5.17 per share, virtually wiping out their former slim equity. This disastrous figure included a reserve of $8,800,000 for future losses on investments. Nonetheless, the directors had bravely declared an extra dividend of 5 cents right after the close of the fiscal year. But more trouble was in sight. The company's auditors refused to certify the financial statements for 1969 to 70, and the shares were suspended from trading on the American Stock Exchange. In the over-the-counter market, the bid price dropped below $2 per share. Real estate investment trust shares had typical price fluctuations after 1969. The low in 1970 was 161 halves, with a recovery to 265 sixths in early 1971. The latest reported earnings were $1.50 per share, and the stock was selling moderately above its 1970 book value of $21.60. The issue may have been somewhat overpriced at its record high in 1968, but the shareholders have been honestly and well served by their trustees. The real estate equities story is a different and a sorry one. Pair 2, air products and chemicals, industrial and medical gases, etc., and air reduction company, industrial gases and equipment, chemicals. Even more than our first pair, these two resemble each other in both name and line of business. The comparison they invite is thus of the conventional type in security analysis, while most of our other pairs are more heteroclite in nature. Products is a newer company than reduction, and in 1969 had less than half the other's volume. Nonetheless, its equity issues sold for 25% more in the aggregate than air reduction's stock. As Table 18.2 shows, the reason can be found both in air reduction's greater profitability and in its stronger growth record. We find here the typical consequences of a better showing of quality. Air products sold at 161 halves times its latest earnings against only 9.1 times for air reduction. Also, air products sold well above its asset backing, while air reduction could be bought at only 75% of its book value. Air reduction paid a more liberal dividend, but this may be deemed to reflect the greater desirability for air products to retain its earnings. Also, air reduction had a more comfortable working capital position. On this point we may remark that a profitable company can always put its current position in shape by some form of permanent financing. But by our standards, air products was somewhat overbonded. If the analyst were called on to choose between the two companies, he would have no difficulty in concluding that the prospects of air products looked more promising than those of air reduction. But did this make air products more attractive at its considerably higher relative price? We doubt whether this question can be answered in a definitive fashion. In general, Wall Street sets quality above quantity in its thinking, and probably the majority of security analysts would opt for the better but dearer air products as against the poorer but cheaper air reduction. Whether this preference is to prove right or wrong is more likely to depend on the unpredictable future than on any demonstrable investment principle. In this instance, Air Reduction appears to belong to the group of important companies in the low multiplier class. If, as the studies referred to above would seem to indicate, that group as a whole is likely to give a better account of itself than the high multiplier stocks, then Air Reduction should logically be given the preference, but only as part of a diversified operation. Also, a thoroughgoing study of the individual companies could lead the analyst to the opposite conclusion, but that would have to be for reasons beyond those already reflected in the past showing. Sequel: Air Products stood up better than Air Reduction in their 1970 break, with a decline of 16% against 24%. However, Reduction made a better comeback in early 1971, rising to 50% above its 1969 close, against 30% for Products. In this case, the low multiplier issue scored the advantage, for the time being, at least. Pair 3, American Home Products Company, drugs, cosmetics, household products, candy, and American Hospital Supply Company, distributor and manufacturer of hospital supplies and equipment. These were $2 billion goodwill companies at the end of 1969, representing different segments of the rapidly growing and immensely profitable health industry. We shall refer to them as home and hospital, respectively. Selected data on both are presented in Table 18.3. They had the following favorable points in common: excellent growth, with no setbacks since 1958, that is, 100% earnings stability, and strong financial condition. The growth rate of hospital up to the end of 1969 was considerably higher than home's. On the other hand, home enjoyed substantially better profitability on both sales and capital. In fact, the relatively low rate of hospital's earnings on its capital in 1969, only 9.7%, raises the intriguing question whether the business then was in fact a highly profitable one, despite its remarkable past growth rate in sales and earnings. When comparative price is taken into account, home offered much more for the money in terms of current, or past, earnings and dividends. The very low book value of home illustrates a basic ambiguity or contradiction in common stock analysis. On the one hand, it means that the company is earning a higher return on its capital, which in general is a sign of strength and prosperity. On the other, it means that the investor at the current price would be especially vulnerable to any important adverse change in the company's earnings situation. Since hospital was selling at over 4 times its book value in 1969, this cautionary remark must be applied to both companies. Conclusions: our clear-cut view would be that both companies were too rich at their current prices to be considered by the investor who decides to follow our ideas of conservative selection. This does not mean that the companies were lacking in promise. The trouble is, rather, that their price contained too much promise and not enough actual performance. For the two enterprises combined, the 1969 price reflected almost $5 billion of goodwill valuation. How many years of excellent future earnings would it take to realize that goodwill factor in the form of dividends or tangible assets? Short-term sequel. At the end of 1969, the market evidently thought more highly of the earnings prospects of hospital than of home, since it gave the former almost twice the multiplier of the latter. As it happened, the favored issue showed a microscopic decline in earnings in 1970, while home turned in a respectable 8% gain. The market price of hospital reacted significantly to this one-year disappointment. It sold at 32 in February 1971, a loss of about 30% from its 1969 close, while home was quoted slightly above its corresponding level. Pair 4, H&R Block Incorporated, Income Tax Service, and Bluebell Incorporated, manufacturers of work clothes, uniforms, etc. These companies rub shoulders as relative newcomers to the New York Stock Exchange, where they represent two very different genres of success stories. Bluebell came up the hard way in a highly competitive industry, in which eventually it became the largest factor. Its earnings have fluctuated somewhat with industry conditions, but their growth since 1965 has been impressive. The company's operations go back to 1916 and its continuous dividend record to 1923. At the end of 1969, the stock market showed no enthusiasm for the issue, giving it a price-earnings ratio of only 11, against about 17 for the S&P Composite Index. By contrast, the rise of H&R Block has been meteoric. Its first published figures date only to 1961, in which year it earned $83,000 on revenues of $610,000. But 8 years later, on our comparison date, its revenues had soared to $53.6 million and its net to $6.3 million. At that time, the stock market's attitude toward this fine performer appeared nothing less than ecstatic. The price of 55 at the close of 1969 was more than 100 times the last reported 12 months' earnings, which of course were the largest to date. The aggregate market value of $300 million for the stock issue was nearly 30 times the tangible assets behind the shares. This was almost unheard of in the annals of serious stock market valuations. At that time, IBM was selling at about 9 times and Xerox at 11 times book value. Our Table 18.4 sets forth in dollar figures and in ratios the extraordinary discrepancy in the comparative valuations of Block and Blue Bell. True, Block showed twice the profitability of Blue Bell per dollar of capital, and its percentage growth in earnings over the past 5 years, from practically nothing, was much higher. But as a stock enterprise, Blue Bell was selling for less than 1/3 the total value of Block, although Blue Bell was doing 4 times as much business, earning 21/2 times as much for its stock, had 51/2 times as much intangible investment, and gave 9 times the dividend yield on the price. Indicated conclusions. An experienced analyst would have conceded great momentum to Block, implying excellent prospects for future growth. He might have had some qualms about the dangers of serious competition in the income tax service field, lured by the handsome return on capital realized by Block. But mindful of the continued success of such outstanding companies as Avon Products in highly competitive areas, he would have hesitated to predict a speedy flattening out of the Block growth curve. His chief concern would be simply whether the $300 million valuation for the company had not already fully valued and perhaps overvalued all that one could reasonably expect from this excellent business. By contrast, the analyst should have had little difficulty in recommending Blue Bell as a fine company, quite conservatively priced. Sequel to March 1971. The 1970 neopanic lopped 1/4 off the price of Blue Bell and about 1/3 from that of Block. Both then joined in the extraordinary recovery of the general market. The price of Block rose to 75 in February 1971, but Blue Bell advanced considerably more, to the equivalent of 109, after a 3-for-2 split. Clearly Blue Bell proved a better buy than Block as of the end of 1969. But the fact that Block was able to advance some 35% from that apparently inflated value indicates how wary analysts and investors must be to sell good companies short, either by word or deed, no matter how high the quotation may seem. Pair 5, International Flavors and Fragrances, Flavors, etc., for other businesses, and International Harvester Company, truck manufacturer, farm machinery, construction machinery. This comparison should carry more than one surprise. Everyone knows of International Harvester, one of the 30 giants in the Dow Jones Industrial Average. How many of our readers have even heard of International Flavors and Fragrances, next door neighbor to Harvester on the New York Stock Exchange list? Yet, Mirabile Dictu, IFF was actually selling at the end of 1969 for a higher aggregate market value than Harvester. $747 million versus $710 million. This is the more amazing when one reflects that Harvester had 17 times the stock capital of Flavors and 27 times the annual sales. In fact, only 3 years before, the net earnings of Harvester had been larger than the 1969 sales of Flavors. How did these extraordinary disparities develop? The answer lies in the two magic words, profitability and growth. Flavors made a remarkable showing in both categories, while Harvester left everything to be desired. The story is told in Table 18.5. Here we find Flavors with a sensational profit of 14.3% of sales. Before income tax the figure was 23%, compared with a mere 2.6% for Harvester. Similarly, Flavors had earned 19.7% on its stock capital against an inadequate 5.5% earned by Harvester. In 5 years the net earnings of Flavors had nearly doubled, while those of Harvester practically stood still. Between 1969 and 1959 the comparison makes similar reading. These differences in performance produced a typical stock market divergence in valuation. Flavors sold in 1969 at 55 times its last reported earnings, and Harvester at only 10.7 times. Correspondingly, Flavors was valued at 10.4 times its book value, while Harvester was selling at a 41% discount from its net worth. Comment and conclusions. The first thing to remark is that the market success of Flavors was based entirely on the development of its central business, and involved none of the corporate wheeling and dealing, acquisition programs, top-heavy capitalization structures, and other familiar Wall Street practices of recent years. The company has stuck to its extremely profitable knitting, and that is virtually its whole story. The record of Harvester raises an entirely different set of questions. But these two have nothing to do with high finance. Why have so many great companies become relatively unprofitable even during many years of general prosperity? What is the advantage of doing more than $21.5 billion of business if the enterprise cannot earn enough to justify the shareholders' investment? It is not for us to prescribe the solution of this problem. But we insist that not only management but the rank and file of shareholders should be conscious that the problem exists and that it calls for the best brains and the best efforts possible to deal with it. From the standpoint of common stock selection, neither issue would have met our standards of sound, reasonably attractive, and moderately priced investment. Flavors was a typical brilliantly successful but lavishly valued company. Harvester's showing was too mediocre to make it really attractive even at its discount price. Undoubtedly there were better values available in the reasonably priced class. Sequel to 1971, the low price of Harvester at the end of 1969 protected it from a large further decline in the bad break of 1970. It lost only 10% more. Flavors proved more vulnerable and declined to 45, a loss of 30%. In the subsequent recovery both advanced, well above their 1969 close, but Harvester soon fell back to the 25 level. Pair 6, McGraw-Edison, Public Utility and Equipment, Housewares, McGraw-Hill Incorporated, Books, Films, Instruction Systems, Magazine and Newspaper Publishers, Information Services. This pair with so similar names, which at times we shall call Edison and Hill, are two large and successful enterprises in vastly different fields. We have chosen December 31, 1968, as the date of our comparison, developed in Table 18.6. The issues were selling at about the same price, but because of Hill's larger capitalization it was valued at about twice the total figure of the other. This difference should appear somewhat surprising, since Edison had about 50% higher sales and 1/4 larger net earnings. As a result, we find that the key ratio, the multiplier of earnings, was more than twice as great for Hill as for Edison. This phenomenon seems explicable chiefly by the persistence of a strong enthusiasm and partiality exhibited by the market toward shares of book publishing companies, several of which had been introduced to public trading in the later 1960s. Actually, by the end of 1968 it was evident that this enthusiasm had been overdone. The Hill shares had sold at 56 in 1967, more than 40 times the just reported record earnings for 1966. But a small decline had appeared in 1967 and a further decline in 1968. Thus the current high multiplier of 35 was being applied to a company that had already shown 2 years of receding profits. Nonetheless, the stock was still valued at more than 8 times its tangible asset backing, indicating a goodwill component of not far from $1 billion. Thus the price seemed to illustrate, in Dr. Johnson's famous phrase, the triumph of help over experience. By contrast, McGraw-Edison seemed quoted at a reasonable price in relation to the high general market level and to the company's overall performance and financial position. Sequel to early 1971, the decline of McGraw-Hill's earnings continued through 1969 and 1970, dropping to $1.02 and then to $1.82 per share. In the May 1970 debacle, its price suffered a devastating break to 10, less than a fifth of the figure 2 years before. It had a good recovery thereafter, but the high of 24 in May 1971 was still only 60% of the 1968 closing price. McGraw-Edison gave a better account of itself, declining to 22 in 1970 and recovering fully to 411 halves in May 1971. McGraw-Hill continues to be a strong and prosperous company. But its price history exemplifies, as do so many other cases, the speculative hazards in such stocks created by Wall Street through its undisciplined waves of optimism and pessimism. Pair 7, National General Corporation, a large conglomerate, and National Presto Industries, diverse electric appliances, ordnance. These two companies invite comparison chiefly because they are so different. Let us call them General and Presto. We have selected the end of 1968 for our study, because the write-offs taken by General in 1969 made the figures for that year too ambiguous. The full flavor of General's far-flung activities could not be savored the year before, but it was already conglomerate enough for anyone's taste. The condensed description in the stock guide read nationwide theater chain, motion picture and TV production, savings and loan association, book publishing. To which could be added, then or later, insurance, investment banking, records, music publishing, computerized services, real estate, and 35% of Performance Systems Incorporated. Name recently changed from Mini Pearl's Chicken System Incorporated. Presto had also followed a diversification program, but in comparison with General it was modest indeed. Starting as the leading maker of pressure cookers, it had branched out into various other household and electric appliances. Quite differently, also, it took on a number of ordnance contracts for the U.S. government. Our Table 18.7 summarizes the showing of the companies at the end of 1968. The capital structure of Presto was as simple as it could be, nothing but 1,478,000 shares of common stock, selling in the market for $58 million. Contrastingly, General had more than twice as many shares of common, plus an issue of convertible preferred, plus 3 issues of stock warrants calling for a huge amount of common, plus a towering convertible bond issue, just given in exchange for stock of an insurance company, plus a goodly sum of non-convertible bonds. All this added up to a market capitalization of $534 million, not counting an impending issue of convertible bonds, and $750 million, including such issue. Despite National General's enormously greater capitalization, it had actually done considerably less gross business than Presto in their fiscal years, and it had shown only 75% of Presto's net income. The determination of the true market value of General's common stock capitalization presents an interesting problem for security analysts and has important implications for anyone interested in the stock on any basis more serious than outright gambling. The relatively small $41 convertible preferred can be readily taken care of by assuming its conversion into common, when the latter sells at a suitable market level. This we have done in Table 18.7, but the warrants require different treatment. In calculating the full dilution basis, the company assumes exercise of all their warrants, and the application of the proceeds to the retirement of debt, plus use of the balance to buy in common at the market. These assumptions actually produced virtually no effect on the earnings per share in calendar 1968, which were reported as $1.51 both before and after allowance for dilution. We consider this treatment illogical and unrealistic. As we see it, the warrants represent a part of the common stock package and their market value is part of the effective market value of the common stock part of the capital. See our discussion of this point on p. 415 above. This simple technique of adding the market price of their warrants to that of the common has a radical effect on the showing of National General at the end of 1968, as appears from the calculation in Table 18.7. In fact, the true market price of the common stock turns out to be more than twice the quoted figure. Hence the true multiplier of the 1968 earnings is more than doubled, to the inherently absurd figure of 69 times. The total market value of the common stock equivalents then becomes $413 million, which is over 3 times the tangible assets shown therefore. These figures appear the more anomalous when comparison is made with those of Presto. One is moved to ask, how could Presto possibly be valued at only 6.9 times its current earnings when the multiplier for General was nearly 10 times as great? All the ratios of Presto are quite satisfactory, the growth figure suspiciously so, in fact. By that we mean that the company was undoubtedly benefiting considerably from its war work, and the shareholders should be prepared for some falling off in profits under peacetime conditions. But, on balance, Presto met all the requirements of a sound and reasonably priced investment, while General had all the earmarks of a typical conglomerate of the late 1960s vintage, full of corporate gadgets and grandiose gestures, but lacking in substantial values behind the market quotations. Sequel, General continued its diversification policy in 1969, with some increase in its debt. But it took a whopping write-off of millions, chiefly in the value of its investment in the mini Pearl Chicken deal. The final figures showed a loss of $72 million before tax credit and $46.4 million after tax credit. The price of the shares fell to 161 halves in 1969 and as low as 9 in 1970, only 15% of its 1968 high of 60. Earnings for 1970 were reported as $2.33 per share diluted, and the price recovered to 281 halves in 1971. National Presto increased its per share earnings somewhat in both 1969 and 1970, marking 10 years of uninterrupted growth of profits. Nonetheless, its price declined to 211 halves in the 1970 debacle. This was an interesting figure, since it was less than 4 times the last reported earnings, and less than the net current assets available for the stock at the time. Late in 1971 we find the price of National Presto 60% higher, at 34, but the ratios are still startling. The enlarged working capital is still about equal to the current price, which in turn is only 51 halves times the last reported earnings. If the investor could now find 10 such issues for diversification, he could be confident of satisfactory results. Pair 8, Whiting Corporation, Materials Handling Equipment, and Wilcox & Gibbs, small conglomerate. This pair are close but not touching neighbors on the American Stock Exchange list. The comparison, set forth in Table 18.8a, makes one wonder if Wall Street is a rational institution. The company with smaller sales and earnings, and with half the tangible assets for the common, sold at about 4 times the aggregate value of the other. The higher valued company was about to report a large loss after special charges, It had not paid a dividend in